Trump's big, beautiful tax bill just passed. What does that mean for you? What does it mean for your retirement, for your taxes, for your Social Security, for your healthcare? What does it mean? A lot of articles have paid attention to certain aspects of this bill, and I'm going to share what this could mean for your retirement, so by the end of the video, you feel comfortable with what planning steps you need to take going forward. And be sure to listen to the end, because I'm going to share something that's not quite talked about, I think, enough about how this may affect you, and it doesn't have as much to do with money as it does to do with lifestyle. So stay tuned to hear what that will be. I'm Elliot Apple, founder and financial planner of Kindness Financial Planning, and I am glad that there is a bill that has been passed earlier in the year rather than later in the year. Oftentimes when we've seen tax legislation, we are getting it in December, so at least now we can take some planning steps around this as opposed to scrambling at the end of the year to figure out what this means. We can actually take some time to understand this and implement it going forward. So this is my understanding of it today and how it may affect you. Now, what are the major changes for this bill? The major change is that the Tax Cuts and Jobs Act, those tax rates were due to sunset at the end of this year. So starting next year, we would have been in a higher tax situation because we would have gone back to 2017 tax rates adjusted for inflation. So this just means that the tax rates that we have right now, they're permanent. And I say permanent with an asterisk, meaning permanent until it gets changed. We've had plenty of tax legislation in this country to change top tax rates for tax rates in between, and lots of other things within tax code legislation. So just keep in mind that it's permanent until it's changed, but it does at least give us something to plan for until a new political administration comes in to potentially try to pass legislation to change the tax rates. What does this mean for a lot of people? It means the tax brackets are going to stay wider and lower than they would have otherwise. Now, this is a boon mostly for high income earners. There are estimates that people making $217,000 per year will save on average about $12,500 through this tax legislation. That amounts to about 3.4% of after-tax income. And if you look at estimates that other people have done, generally lower income not going to benefit quite as much. Maybe it's 0.5%, maybe even a detriment for some people out there where tax rates actually rise on lower income earners. Generally, this bill is better for people with higher incomes. And we'll go into detail a little bit more about people who are older than 65 in a moment. For those who are collecting Social Security and above the age of 65, there is going to be a benefit here. Trump had talked about how he wanted to eliminate taxes on Social Security benefits. Now, did that actually end up happening? No. But there is a slight benefit that was worked into this bill, and it's an extra deduction of $6,000 per person, or $12,000 for a married filing jointly, but there are some phase-out ranges to contend here with. It starts at $75,000 of modified adjusted gross income, where that $6,000 benefit will start to decrease, and it will be fully phased out at $150,000 worth of income. For those married filing jointly, it's going to start at $150,000 where that phase out starts to begin and fully phase out at about $250,000. So if you have lower income and you're above the age of 65 and you're collecting Social Security benefits, you can look forward to potentially paying less on your Social Security benefits in terms of taxes. Now, something to keep in mind is Social Security for some people are already not taxable at all because their income's low enough. Social Security is somewhere between 0% and 85% taxable. So fun fact, not even all of your Social Security benefits are taxed as it is today. Now, this is important because right now estimates are that there's about 64% of the population that does not pay taxes on their Social Security benefits. With the passing of this bill, they estimate that may go up to 88%, which is a pretty wide variety of the population if you think about it. Only about 12% are estimated to actually pay tax on their Social Security benefits going forward. So this extra $6,000 benefit per person is a pretty big boost for those collecting Social Security and who are above the age of 65. Now, that is something to keep in mind, that you actually have to be 65 years or older. So if you're collecting Social Security at age 62, you don't actually get this $6,000 benefit. Now, what does this mean for people in terms of what is happening between their itemized deduction and their standard deduction? So what's important here is you don't actually have to itemize your deductions to get this $6,000 benefit. So for a married couple filing jointly, for 2025 as an example, you might get your $30,000 standard deduction plus your $1,300 per individual in terms of a bonus for being older, so $3,600 in total for that, and then $6,000 or $12,000 for a married couple. So in all, you end up with a standard deduction of $46,700, which is a pretty big boost compared to what it was before. So that's just something to keep in mind for those people in those situations that aren't affected by the modified adjusted gross income phase out. you may end up paying less in taxes because of that. If you're not sure how this bill affects you directly, click the description down below. There's a link. You can schedule a time with me. I'd love to talk to you more about what this bill means for you and planning opportunities I see that you could potentially take advantage of. Now back to it. Trump also promised to not tax tips. Now, did that end up happening? No, but like Social Security benefits, there is a benefit here in that the first $25,000 worth of tip income won't be taxed, but it is subject to a phase out. That phase out is $150,000 for people who are single and $300,000 for those married filing jointly. Now, I mentioned at the beginning of this video that there was something I was concerned about that wasn't necessarily money related, though it could be related somewhat. But this is the cut to Medicaid. There's about $1 trillion cut to Medicaid, which is ginormous. Hospital administrators have come out, organizations have said, this is going to hurt healthcare. Now, you may be thinking, I'm not on Medicaid, I'm not affected. Why does that matter for me? Well, the problem is, particularly in rural areas, but this also affects metro populations where Medicaid people go into hospitals and use care, Medicaid covers some of that bill. If Medicaid can no longer cover that bill, those hospitals and other healthcare providers are going to eat those costs, and what happens for everybody else? Those prices get raised, and that's a real problem. They get raised or services get cut, so there's a lot of concern right now where people basically come out and said, hey, this is going to close rural hospitals, or it's going to reduce staff. We're going to have to let people go. We're not going to offer the same level of healthcare. And that's my main concern with this portion of the bill, where people aren't necessarily paying quite as much that they go, hey, taxes, great, there's a reduction here, but what does that mean for the quality of your care? I always hear from people already how difficult it is to find a doctor, and I can only imagine what that's going to look like going forward with reduced accessibility essentially to doctors out there because of these Medicaid cuts. So that's something to watch, that if you're a retiree, you're planning on using healthcare, particularly in a rural area, but also in metro populations, you may have even more trouble using that in the future. A few minor things that got added to this bill: a child tax credit, so that's going to be $2,200 in 2025, and that will be indexed for inflation. You also have auto loan interest on US made cars. So if you take out a loan for a new US made car, you could potentially deduct up to $10,000 worth of that auto loan interest. The other big thing you saw in this bill that was debated quite a bit are SALT taxes, or the state and local taxes. Right now, there is a cap that was passed during the Tax Cuts and Jobs Act of $10,000 per year. A lot of people who were in states with higher property taxes, higher income taxes, basically said, I'm paying a lot more than $10,000. I can't deduct that at the federal level anymore. So there was a fight or a push for this, and that has been increased to $40,000. Now, what's important to keep in mind is that $40,000 only goes through 2029, and then in 2030, if no other legislation is passed, that bounces back down to $10,000. We do see an increase from that $40,000 each year of approximately a 1% increase. So there will be some relief for people who are paying more for those SALT taxes going forward. Something else that was contentious for a while but ended up staying in this bill is that a lot of states have come up with loopholes for businesses to be able to pay these SALT taxes. And what ends up being there is they can still fully deduct these taxes with some of these loopholes that they've worked around. So if you are a small business owner, that's just something to pay attention to. Another small minor thing that I don't have a lot to say, but just to know, is the QBI deduction did get added into this. So there was talk about that between 20 and 23%. 20% is what went into that final bill. So for people who qualify for that QBI deduction, that's just something to pay attention to when you're planning your income year to year. When it comes to estate taxes and those in the ultra high net worth space, there was concern around that estate tax getting reduced to a small amount relative to what it was before. It's now $15 million per person, or $30 million for a married filing jointly couple. So for those who are in that range of maybe $5 to $15 million, maybe there's less planning to be done than there was prior to that, but that's just something to keep an eye on, particularly if you're in a state anyway that has a low estate tax exemption. Washington, Oregon, and a few other states, I'm looking at you, where you still need to do some planning on this because you may not be affected by federal estate taxes, but on the state level that will affect you. Clean energy credits, those were also a big one out there. If you're planning on an electric vehicle, if you don't have that or haven't paid or bought that by September 30th, check the details exactly on when that is, but September 30th is the date that they had talked about. That $7,500 credit, if you qualified for it, is going away. Also home improvement projects, stuff like that. essentially you're not going to get that credit anymore. So there have been some changes there that you want to be mindful of going forward. So what does this mean for planning opportunities? The last couple of years, a lot of people, myself included, have focused on Roth conversions, converting money at a lower rate, moving money from an IRA to a Roth so that can grow tax-free, move on to your heirs, income tax-free. Does that mean that goes away? Not necessarily. I think there are still good reasons to analyze Roth conversions year to year. It's still possible tax rates rise in the future. We don't know what politics will look like in a few years, whether we need to raise taxes because of the national debt. That's a huge concern with this bill. It's raising it over $3 trillion, our initial estimates. So I don't think that goes away, particularly if you're potentially moving states or you care about optimizing taxes over your heirs' lifetime as well. Simple example, if you have a $2 million IRA today, maybe you have 2 kids that's going to in the future, and they're in their peak earning years. Let's say they just, easy math, they distribute $100,000 per year to get it out of that. $100,000 plus whatever they're earning already. That may bump them into a high bracket under today's tax rate, but then what if tax rates go up in the future? Or what if you move states to a higher income tax rate? Maybe you want to do Roth conversions now. There's still good reasons to analyze that. There's still good reasons to do tax projections year to year as you pay attention to capital gains. With Social Security and that phase out right now with that $6,000 additional deduction, that's going to be something that you need to pay more attention to, along with the regular things that you would with IRMA, and that potentially going up in the future with higher requirement of distribution. So I don't think Roth conversion planning is dead. I think it's something to pay attention to, particularly as we don't know what tax rates will look like in the future, just like we didn't know when this tax legislation was passed, when the original Tax Cuts and Jobs Act was passed. So keep planning your income year to year, do those tax projections, work with a professional, or do it yourself so that way you're staying up to date on what's best for you. Thanks for watching.